Good evening to you, ladies and gentlemen. Welcome to the presentation on capital regulation, how much is too much, conducted by Dr. Raghuram Rajan, Governor of the Reserve Bank of India. May I now invite with great honor, Governor of the Central Bank of Sri Lanka, Mr. Ajit Cabral, to formally welcome you and to introduce Dr. Raghuram Rajan. Ladies and gentlemen, Governor of the Central Bank, Mr. Cabral.
Your Excellencies, fellow governors from the SAARC region, deputy governors, members of the Monetary Board, my dear friends, first of all, let me welcome all of you to this presentation on capital regulation, how much is too much, to be made by Dr. Raghuram Rajan, who is the Governor of the Reserve Bank of India. Dr. Raghuram Rajan took charge as the 23rd Governor of the Reserve Bank of India in September 2013. And prior to that, he was the Chief Economic Advisor to the Ministry of Finance, Government of India, and the Eric J. Gleacher Distinguished Service Professor of Finance at the University of Chicago's Booth School. He was also the Chief Economist at the International Monetary Fund from 2003 to 2006. And he has chaired the Indian government's Committee on Financial Sector Reforms from 2007 to 2008. Dr. Rajan has attained his BTech degree from the IIT Delhi in 1985, an MBA from IIM Ahmedabad in 1987, and a PhD from MIT US in 1991. His work spans a broad range of areas in financial economics, most important to the development of economics worldwide, ranging from the central role of banks in creating liquidity and the role of finance in economic growth to the nature of corporations and their financing. So a wide range of disciplines that he has been able to contribute to the world. He has co-authored Saving Capitalism from the Capitalists, not a bad thing to do. And then he wrote Fault Lines, How Hidden Fractures Still Threaten the World Economy, for which he was awarded the Financial Times Goldman Sachs Prize for Best Business Book in 2010. Dr. Rajan is a member of the Group of 30. He was the president of the American Finance Association in 2011 and is a member of the American Academy of Arts and Sciences. In January 2003, the American Finance Association awarded Dr. Rajan the inaugural Fisher Black Prize for the Best Finance Researcher under the age of 40. The other awards he has received include the Global Indian of the Year Award from NASSCOM in 2011, the Infosys Prize for the Economic Sciences in 2012, and the Center for Financial Studies Deutsche Bank Prize for Financial Economics in 2013. I think all these experiences that Dr. Rajan has been able to gain is now being used in a practical sense to be the Governor of the Reserve Bank of India, and we're sure that he will be able to steer the country to greater heights in time to come, and we wish him all success in doing so. And without taking much of your time, I now invite Dr. Raghuram Rajan to make this presentation on capital regulation, how much is too much. Dr. Rajan.
Thank you very much, Governor Cabral, fellow governors from the SAARC region, deputy governors, distinguished invitees, excellencies, and friends. You may think, how dry can one get at 6:30 or 5:30 in the evening and, after a long day's work. Why is this such an important issue? Well, clearly for central banks, and we spend a lot of our time on this issue, but I think it's one of those issues which seemingly technical at first really is, when you probe deeper, has a whole lot of interesting implications, including the political economy of our times. Over the last few years, we've had an enormous interest in capital regulation. That is basically how much capital should banks hold. Now, this has come after the great financial crisis when, in fact, banks got into a lot of trouble as a result of the bad decisions they made. Now, question is, how much of the trouble was because of too little capital? How much of the trouble was because of other reasons? And one could debate that for a long time. But a lot of the focus in recent times has been on how we make sure these banks never get into trouble again. And it is being driven by a variety of forces. Well, first, of course, regulators have a national interest to see that the banks don't get into trouble and harm the financial system. But there's also a lot of anger in the public, especially in industrial countries, especially in countries that went to the brink, countries like Switzerland, countries like the UK, where their banks were bigger than the economies effectively, and took them to the verge of disaster. And the anger there is partly that the economies got into deep trouble, especially the UK and the Eurozone, but also that soon after, the bankers started making a ton of money once again, despite having been rescued by the governments. And while there was massive unemployment on Main Street, the banks were business as usual soon after. So the broader question there has been, why hasn't no banker gone to jail? Why haven't the bankers been put away for what happened? Why is it that we're paying the price in terms of unemployment and so on, but they seem to have gone scot-free? And actually, if you look at the cases that are being filed against the banks, it's very hard for the authorities to find evidence of criminal behavior. Not to say there hasn't been any, there has been some. But largely, this was a situation of bad incentives, bad behavior, but not criminal. And as a result, what they tried doing was levy huge fines on the banks. We're still seeing that happen. Some of it, again, I don't want to absolve the banks of all criminality. Some of it, especially in the collusion in some of these foreign exchange markets, etc., smells of something which may have violated laws. But they've got the banks to agree to large fines without ever taking them through court, because taking them through court would be very difficult. But what more? How else can the banks be penalized? And so over and above the regulatory incentive to make sure they don't cause trouble again, there is a political economy being driven by politicians who are angry, the public who's angry, everybody looking for some kind of scapegoat and trying to find some way to get back at the banks. And we've had proposals, variety of proposals to cut the banks down to size. Some people have been arguing for limiting the size of the banks, not making sure the banks don't go beyond a certain size. Of course, the question there is, if you eliminate too big to fail, do you get too many to fail as the alternative, that you have a lot of small banks, all of them getting into trouble at the same time and therefore having to be rescued. There are other proposals. For example, the Volcker rule is an attempt to cut away certain activities of the banks to prevent them from doing those activities. Again, in many of these proposals, it's not clear that those activities or those proposals address the issues that got banks into trouble this time around. But in many ways, they seem to be attempts to cutting the banks down to size, to preventing the banks from being big, to teach them a lesson, so to speak. Again, I want to emphasize there is a real regulatory reason to do some of this, but there's also political economy, which is, let's get back at the bankers. Since we can't get them through the courts, let's get back at them in other ways. Now, why do I say this? I say this because it reminds me a lot of what happened in the 1930s, a period which I studied a lot while doing research, where similar things happened. The economy got into trouble, the bankers were blamed, And then there was an attempt to cut the bankers down to size. And people who participated in this were not just the regulators, but they were politicians who for a long time had been arguing that, politicians of various hues who had been arguing that the banks are too powerful, we should limit their power. One of the outcomes of the kind of regulation that happened then was the GlassSteagall Act. The GlassSteagall Act was the act which prevented banks from doing investment banking and separated commercial from investment banking. As a result of all the regulations that happened in the 1930s, you find that banker salaries, which were significantly above salaries in other sectors in the economy, started moving down back to the average in the economy. So the bankers, by limiting their activities, by limiting their ability to make money in certain ways, were in fact cut down to size in the way that most affected them, which is their salaries. What you see down the line in the 1980s is as the kind of restrictions that were put on banks in the 1930s started hurting economic growth, they slowly were whittled away. And there was liberalization in the banking sector. Banks got to do a lot more things. As bankers got to do a lot more things, their salaries also went up. The talent pool in banking went up. They attracted the smartest guys from Princeton and Harvard. And they did all sorts of fancy things, which finally took the banking sector back to disaster once again. And after that, once again, we are thinking of what regulations we put on them. The broader point I'm trying to make is that there's a cycle in these things. We regulate, we keep them out of trouble, we find the regulations are too tough, then we start deregulating. We start deregulating, we over-deregulate, or we deregulate too much. They get into trouble once again we put the regulation. The broader question that one has to ask is, how do we make sure that we get the regulations right? How do we get the right amount of regulation rather than over-regulate in bad times and under-regulate in good times? Regulation in many ways is pro-cyclical, or I should say, pro-cyclical. That is, in good times, I should say counter-cyclical. In good times, we regulate too little when we should be regulating a lot more. And we let these guys get away with murder precisely because it's very hard to follow the dictum that one of the chairmen of the Fed once said. The role of the Fed is to take away the punch bowl when the party gets going. It's very hard to take away the punch bowl when the party gets going, whether it's on monetary policy or on regulation. It's hard to do regulation at the right time. So my question back to today is, we have a whole lot of regulations we're putting on the banks, and there's some more coming. Are we going too far once again? And will we, a few years down the line, especially in countries like ours, the emerging markets, which have a significant need for financing development, figure out that we've gone too far? We've accepted excessive bank capital regulation, and it was too much. We should have done less. That's sort of the question I'm going to ask, but that's the background behind which I'm asking it. And let me ask the question by walking you through some of why we think capital regulation helps. So what is bank capital? It's basically long-term liabilities owned by stakeholders who can accept losses, who can bear losses when things go bad, so that the depositors are protected and eventually the taxpayers are protected from having to pay for the losses in the bank. So capital is usually seen as a loss absorber, and it can be equity capital, it can be long-term bonds issued by the bank. But a second role for capital, when we do capital regulation, when we say you cannot have risk-weighted, your capital has to be more than 10%, say, of your risk-weighted assets. Supposing we say that, it basically means you cannot take more than a certain amount of risk. We are giving you a budget constraint for your risk. If you want to take more risk than this, you have to go out and raise more capital, right? So a second role of capital is as a budget constraint, and basically we're saying that you have to convince investors that you're capable, and therefore raise more capital, then take more risk. If investors, long-term investors who are going to absorb the losses, aren't convinced that you know your business, they won't give you that capital, and therefore you'll be constrained from taking more risk. So in a sense, we are asking the market to do regulation for us. And that comes to the third role. When a bank is able to issue capital and continue growing, it sort of serves as a signal to us regulators that the bank is able to do something good, that the bank is able to raise money from the markets. The markets have seen what the bank does and have given it its stamp of the best stamp of quality by actually putting their money into the bank, right? So capital as a loss absorber, capital as a budget constraint, and capital access to capital as a signal, these are the various ways that capital could work in the real world. And of course, what capital helps us as regulators, how it helps us is it prevents the banks from failing, that it prevents the individual institution from going bad. That's a good thing. Second, if all the banks are well capitalized, the fear that the system may go insolvent because some banks may go bust, and that starts a run which then spreads to other institutions through the process of contagion, that fear is eliminated. The system is healthy. There are limited systemic risks. The threat of a contagious run is limited if the system is well capitalized. Then there is the problem of too big to fail institutions. These are institutions which everybody knows the government will not let go. They will be bailed out. Well, if you have too big to fail institutions, for example, Citibank, which was bailed out during the crisis, the concern is these too big to fail institutions will not be subject to appropriate market discipline. Since everybody knows these banks will not be let go, people are willing to put their money into the banks regardless of how bad the bank is doing. It's a $4 trillion bank. There's no way anybody let it go. I don't care what it's doing. I'll just put my money in because there's no way it will go under. So when you have too big to fail institutions, market discipline breaks down, and therefore the regulators have a legitimate interest in saying, look, there's no market discipline, so I'm going to put the capital hurdle higher. I'm going to ask it to raise more capital because it's forced to go out. But more important, the chances of it eating through that capital, no matter how badly it does, is smaller, and therefore the system is better protected, the taxpayer is better protected. Therefore, we have additional capital requirements for too big to fail institutions. And now there's yet another element that is attempting to, that some industrial countries are trying to introduce, which is saying, okay, we put all this capital and yet it may be eaten through. And so over and above that, to protect our taxpayer, to protect the taxpayer in the UK, to protect the taxpayer in Switzerland, where the banks are bigger than the countries, we need yet another layer of protection. And that layer of protection is going to be what they call gone concern loss absorbing capacity, which is basically some other instruments which will kick in additional money if the bank goes bust, if it eats through all its capital. So these are the various reasons for capital. I'll come back to GLAX in a second. So we're putting all this capital, and that raises the question, what's the cost of putting all this capital? Is there a problem, right? The bankers immediately say, of course there's a problem, of course there's a problem. If you ask us to raise more capital to run our business, our cost of funding goes up. And because our cost of funding goes up, we have to charge borrowers more, and that is going to hurt growth. So don't ask us to put too much capital, right? Now, the immediate response from a number of academics to this, most prominent amongst them is a couple called Admati and Helwig. They have resurrected a well-known finance theorem called the Modigliani-Miller theorem. And what does Modigliani-Miller say? We have some finance professors here. Mr. Srinivas? Any finance professors? Anybody who wants to talk about Modigliani-Miller? No? I have to give my finance lecture. Well, Modigliani Miller basically says that, look, the risk of any bank is determined by the assets that it holds. That's what you're financing. It doesn't matter how much equity or how much debt you finance it with, the risk of the assets will go on to whatever liabilities you've issued to finance it. So, cut a long story short, your cost of financing is not affected by whether you issue equity or issue debt. The assets remaining the same, the cost of finance will remain the same. Put differently, if I ask you to have 30% of your liabilities being equity and 70% debt, instead of 90% debt and 10% equity, your cost of equity plus debt will remain the same. Why? Because in the first case, you've got a lot of equity, therefore your debt is much safer. Therefore, when you issue the debt in the market, you will get a much lower interest rate. And therefore, when you pay that lower interest rate, even though you're issuing more equity and paying a higher dividend on the equity, the weighted average cost of capital will remain the same. Okay? That takes usually 3 classes for my students to get that. But basically the point is, they're arguing, look, you bankers, you're wrong. If we ask you to hold more equity, if we increase the capital requirements on you, you will be safer because you'll get into trouble less because of the higher equity holdings. That will make the cost of debt that you issue, the borrowed money that you have, lower, and therefore the argument you make, therefore that you will be charging borrowers a higher amount is absolutely wrong. It won't make a difference. Okay? Now, truth be told, what these academics miss out is a whole rationale for a bank. If you think about it, banks have been financed with short-term liabilities, short-term deposits, demandable deposits. They're not any short-term deposits, they're demandable deposits, which is what makes banks subject to runs. They've been financed this way since the 11th century AD, since early Italy. In fact, Roman banks used to have a similar structure. And so you have to ask yourself, isn't there something special about the structure which gives the structure, at one hand, it makes it more fragile, on the other hand, may make it a more effective structure. And I think the argument that other academics have used for why the bank structure is special is when you issue these short-term liabilities, or let me put it the other way. Supposing somebody came to you and said, I want you to finance me with equity. With equity, you pay a dividend as and when you make money. If you don't make money, you don't pay dividends, right? They come to you and say, give me 100% equity, I will run a business. Whenever I make money, I'll pay you. What would your response to that be? If somebody said, trust me, give me a lot of money, don't ask me any questions. When I make money, I'll give it back to you. But until I make money, you have no rights over me. Right? That's equity, right? And unless you have superb corporate governance, equity is an asset which doesn't have much control over management, right? And therefore, equity, the assets that can be created when it's financed with equity may be quite different from the assets that will be created when it's financed with a lot of short-term debt. When you finance somebody with debt where you say, I'm going to collect tomorrow the repayment, you're basically saying you better have the money for me, otherwise I'm going to put you in bankruptcy tomorrow, right? Every depositor has the right to take his check to the bank and say, pay me, okay, at any time. That's the demandable deposit. Those kinds of claims exert a certain amount of discipline on the bank, right? Remember how the banks got into trouble. The banks didn't get into trouble because the equity holders said, hey, you're doing awfully funny things with your mortgage-backed securities, why don't you shut down that business? They got into trouble because they couldn't borrow anymore in the wholesale market. They couldn't borrow in the overnight banking market because other banks suspected they were getting into trouble and said, we're not going to renew your deposits. Put differently, there's a lot of discipline that comes from having a capital structure which is largely short-term. That discipline comes from the lenders being able to check on you every day and saying, where's my money, right? If on the other hand you issued only capital, only long-term liabilities and said, trust me, come back in 10 years and I'll tell you whether you've made money or not, you wouldn't have any control over what the banker does with your assets. The point I'm trying to make is that the liability structure affects the kinds of assets that you create. If you have long-term liabilities, which are really long-term without much corporate governance, you can create any assets you want. You can create a risk structure, any risk structure you want. The investors have no control. Once the investors can take their money back every day, you as a bank are forced to manage risk properly. You're forced to hold enough liquidity to pay your lenders. You're forced to take projects that repay on time. You're forced to collect on loans that you've made. All these things, discipline is inflicted on the bank. So bottom line, what am I trying to say? I'm trying to say that a sensible compromise between those that say capital has no cost and those who say that capital is very costly is that moving too far away from the historical bank capital structure, which has some equity, 10, 15%, and a lot of short-term debt through deposits, through wholesale borrowing, 85%. That structure has stood the test of time. And it's a structure which may, in fact, be the appropriate structure to give the bank an appropriate cost of borrowing, and therefore an ability to lend properly. In other words, going too far down the line of saying raise more capital, go to a 30% capital structure, a 40% capital to asset structure may, in fact, as the bankers say, hurt growth by raising the cost of lending to borrowers. At the same time, for banks to complain when they have 50-to-1 leverage ratios that we have enough capital, don't ask us to hold more capital, is also incorrect. They were too levered before the crisis. They probably needed to hold more capital, but probably not as much as some of the critics are suggesting. We need to find an intermediate position. Now, in this intermediate position, some people have come with alternative forms of capital. Some have suggested instead of having equity, perhaps you can issue perpetual debt. Perhaps you can issue contingent convertibles, that's called COCOs, or you can issue debt that gets bailed in. We can leave that for a second and go back to the broader question, how much capital is enough? So I'm arguing that even from a theoretical perspective, you can ask banks perhaps to hold too much capital. But there are other reasons that capital regulation sometimes becomes problematic, right? Now, if I ask you, what was the asset that got banks into trouble before in the great financial crisis? What asset comes to mind? Mortgage-backed securities, right? Mortgage-backed securities was what got banks into trouble. Now, it wasn't individual mortgage-backed security. It was that collectively they had loaded up on mortgage-backed securities. Now, why did they collectively load up on mortgage-backed securities? If I ask you that question, the answer is it had the greatest risk bang for the lowest capital buck. In other words, we required them to hold very little capital against some of these mortgage-backed securities, but it was sufficiently risky that they found the return that they got was wonderful relative to the capital that they held, right? So given that, okay, we have to be a little cautious about putting all our faith in capital regulation. Why? Because it may be that we offer low risk weights for the wrong kind of asset. For example, most recently what you see is the European periphery countries have gone out and loaded up on European periphery government bonds. Okay. Now, does that make sense for countries that are in trouble, that are effectively responsible for bailing out the banks, for the banks of that country to hold the bonds of the government of that country? It sort of seems a little too incestuous, too much stuff going around in the same circles. And the reason that makes sense for those banks is because the country bonds have a very low risk weight. In fact, the banks may basically be making the kind of judgment, why not hold these bonds? Nobody else wants to hold these bonds. I get a high return from it. And anyway, if the country goes bust, I'm toast anyway. So I might as well hold these bonds. Because if the country works out, I'm going to make a killing. And in fact, that's what's happening. Because the countries have been effectively bailed out by central bank policy, the banks of those countries which held the bonds of their countries are making a killing because those bonds are coming back to life. But is this really what we want to do? Is this really how we manage risk in the system, by getting people to load up and create systemic risk? So one of the worries one should have about capital requirements is that the regulator may coordinate by assigning risk weights to different assets which may not be appropriate at a particular time. The regulator may coordinate banks into loading up on the same risks and therefore create the very systemic risk that the regulator is trying to avoid. That's a concern that we certainly should have about capital regulation. Another concern about capital regulation, piling on more capital requirements on the banks, is let us assume it works and we do prevent the banks from taking riskier activities. Where does the risky activity go? Because after all, there's a certain amount of risk in most economies which has to be, yes, it may quell certain amounts of risk-taking, but a lot of the risk has to be found somewhere. If it doesn't go to the banks, it'll go elsewhere. It'll go to the unregulated parts of the financial system. And while we have set capital requirements for the regulated part of the financial system, there's a large part, the shadow financial system, which remains outside regulation. So the more, it's like a balloon, the more you push on this side, the more the other side will bulge out. More you push on risk-taking on the regulated part, that is the part you see, the banks, the more it will go to the hidden part, the shadow financial system. So better to have uniform regulation across the system rather than push too hard on one side and see the risk migrate to the other side. And finally, one of the concerns about capital regulation is we're overemphasizing it. Yes, we have liquidity regulation. But all the capital in the world will not counteract bad incentives. A lot of the problems during the crisis was bad incentives with the bonus structure, with the kinds of return structures that people had. All the capital in the world will not counteract bad governance. If the shareholders don't care, that is going to create enormous problems for the bank. If the shareholders don't understand, if the board is not a sensible board, that can create enormous problems. Similarly, over and above governance and incentives, we need regulators to take the right actions at the right time. If regulators become lax in good times and excessive in bad times, then we have problems also. And finally, we need good resolution. We have these massively complicated institutions. And again, perhaps if we can find ways to resolve them, to shrink them when the time comes very quickly, that may be better than holding significant amounts of more capital. So the point I'm trying to make is the other reasons why we shouldn't emphasize capital regulation too much. One is the possibility regulators may coordinate people through capital regulation into taking some risks which become systemic. Second, that if we don't regulate the shadow financial system but over-regulate the regular financial system, we'll get risk migration into the parts we're not regulating. Third, by focusing on capital regulation, we may underemphasize these other legs, which are equally important, which come under different legs of the Basel system, but because the attention is being paid to capital regulation, we may underemphasize. And the last point, which pertains to many of us here, is do we have the same kind of banks, same kind of financial system as the industrial countries? For instance, is it likely that any one of our banks is going to take our country down with it? And are the kinds of activities they're doing as complex and as hard to understand as the kinds of activities done by industrial country central banks? Now, I'm not saying none of our banks do it. I'm not saying that none of our banks will ever do it in the next 10, 15 years. But the question we have to ask ourselves is, are we being led down a regulatory path which is right for those countries, but not right necessarily for us, because our needs, our financing needs are quite different, and therefore capital requirements may play a much costlier role here, even though the benefits may be more limited. Now, I'm not asserting this. I'm suggesting it's a thought that we should explore, because in many of these situations, we take the agenda that is laid out by industrial countries, but that is being driven by thoughts of the great financial crisis, which hit them much more than it hit us. We may have different problems. And that comes back to what I started with, that to some extent, one of the problems that regulators have is they're subject to incentives also. And many regulators across the world have to show that they're not pro-banker, that they are on the job post-financial crisis, and they are going to do their job well. And some of the regulation we see, why is regulation so strenuous in a downturn? Because regulators have to show that they're worth their salt, that they weren't asleep on the job before, and as a result, we might get excessive regulation in the downturn. I've argued also that the bankers did not pay a price. That is right. They did not pay a price relative to the harm they did, partly because the harm they did, the kinds of actions they did were in many cases not criminal, not in all cases, but in many cases were not criminal, but reflected systemic deficiencies. Now, we have to correct those systemic deficiencies, but it's not just capital which we need to correct. It's governance, it's incentives, it's even the regulatory structure that we need to create. And this is why I worry when yet another attempt to put yet more requirements on banks. What is now being discussed is what is called GLACs, Gone Concern Loss-Absorbing Capacity. This is yet another kind of instrument which some industrial countries want to introduce to make their banks safer, partly because their banks essentially became big charges on the taxpayer, and they don't want it to happen again. Question we have to ask ourselves is this something we need? Do we have the markets to absorb this kind of instrument? Can those markets, are we going to have a harder time with these kinds of instruments? Are they going to impose costs on our banks? And I think the whole point of my discussion today is we need to spend more time thinking about these kinds of things rather than taking for granted that what is good in other countries is good for us. So bottom line, how do we get the right mix of regulation? Are we in danger of veering from too little pre-financial crisis to too much now that the horse has bolted the stable? Do we shut, padlock, and put iron bolts on the door now? And is it the same horse? Or should we be looking at other horses that we have which may bolt? Should we be looking at the banks, or should we be looking at the shadow banks? Certainly some of the developments in China suggest that at least some of the concerns are not in the banks but in the shadow banks. And many of us have shadow banks that we need to look at. But also the crisis may be very different the next time round, and that is why I would say let's develop a more holistic, a broader picture of what went wrong and how to get it right. In a sense, we need cycle-proof regulation, which is what this talk is about. Thank you.